Alrighty, shall we hop straight in?
Yeah, let's do it.
Fantastic. All right. Thanks everyone for joining us. Apologies for the technical difficulties there. Starting a little bit late, but we'll push right ahead. So I won't take up too much of the preso. I'll just give a quick intro and welcome. So my name's Ben. I'm the marketing manager here at McKinley Plowman. We've got a webinar today in partnership with Performance Property Group. So we have Lockie Delahunty here representing them. So he'll be on for about sort of 25 to 30 minutes, just talking about the WA property market and some pretty important and interesting data and really the outlook for the year, and a bit more of a sort of WA-centric look, as all of the focus, certainly from the media, seems to be on the eastern states and some of the struggles they're having there. But there are definitely some good opportunities in the WA market, which Lockie will touch on. And then following him, we have Paul Moran, who's our finance director. So he'll take a bit of time towards the end to discuss finance and loans, and again, some of the opportunities around there, even in the face of sort of rising interest rates and things like that. So without any further ado, here's Lockie.
Thank you very much. All right, guys, you're controlling the slides there for me, Ben.
I am, yep.
Yep, brilliant. If you can just flick through, just for a bit of an overview of what we're going to be chatting about today. Like I said, being in Perth, we sort of get dragged into national conversations. So today, I'll try to spend the majority of the presentation talking through what's happening here locally. Obviously, it's very topical property at the moment. Topical is an understatement when you look at what's happening with the cash rate and interest rates. And so really I'm going to sort of dive into how that's going to impact the Perth market over the next 6 to 12 months, as well as the next sort of 2 to 5 years. We'll finish off with just some examples of what's happening locally on the ground from an investment point of view, and some home buying updates in the western suburbs. If you can flick through there, Ben. Where I'm going to start the conversation is where we were when we caught up in June 2020. So anyone that was a part of this presentation that we did a few years ago, the lay of the land was a lot different to what it is today. So I pulled this slide deck out from the same presentation that we did, obviously, at McKinley Plowman back in 2020, and the landscape was very, very different. Our advice at the time was obviously not to be selling properties. COVID had hit. There's a lot of uncertainty in the market. And why this is important is because we're in the same similar situation now where there is uncertainty in the market. And that's really around interest rates. So people are concerned. There's fear in the market. So I wouldn't say it is at the same stress point as it was when COVID hit. Some of the big banks were forecasting 30 to 40% falls in the market. They're certainly not forecasting that this time around. But our view during 2020 was to be holding property, not to be selling in times of uncertainty. That remains consistent today. And our buy markets, or the opportunities that we saw in the market, were very much centralised around predominantly Brisbane and Adelaide, with Perth in that conversation, and regionally Ballarat and Bendigo. If you can fast track to the next slide there, Ben. Where we are today, obviously these markets have progressed quite aggressively. So leading the race there was the Melbourne market, leading this was the Adelaide market at 43% growth, and that's from the start of COVID to the finish. So we've seen Adelaide did about 43%, followed by Brisbane 39%, Sydney 27%, but that market has now since contracted, which I'll speak about. And then Perth doing its 22%, which was good to see. First bit of growth we've had in 13 years, which was pleasing. So if we look forward onto the next slide, where the lay of the land is as of today. So previously, obviously, I spoke about the figures of where the markets went pre and post COVID. Fast track another 12 months. Obviously, some of these markets are contracted, particularly Sydney. So I understand that market went through a significant period of growth during COVID. It's now contracted 12%, and we're forecasting more declines in that market based on what I'm going to show you as we progress through this presentation. Adelaide's still the strongest performer. When we looked at those regional markets, Ballarat and Bendigo, they outperformed the capital cities during that COVID period. So we saw 45% growth in the regional markets, which was pleasing. And Brisbane was an interesting one because it went through significant growth over that sort of 18-month, 2-year window. But then it was hit with the land tax reform, which took a lot of the investors out of the market. So if you didn't understand that, happy to take that offline. But that was a reform that they were going to bring in to essentially tax anyone that owned property in Australia, in Queensland, if you own property there. So it put a lot of fear into the investment market. So we've seen that market come off even before interest rates went up, and then overlay that with a rising interest rate environment. We've seen that market come off quite aggressively, but we still do think there's value in the market once confidence gets back into the market. And what I mean by confidence, once there's some certainty around the cost of money, so stagnation in interest rate rises, I'm sure Paul will speak to this, whether at the end of that growth or inflation of interest rates or not, is I suppose the key question. But we'll talk through that a little bit in a moment. So go to the next slide, please. So lay of the land: Sydney, Melbourne, Brisbane, Adelaide, Perth, Hobart, Darwin and Canberra. Obviously Sydney's still very much leading the charge there, with the median house price still over $1 million. Got close to 1.3 at the peak of the market. Now has contracted. Looking at Perth, still very affordable there at 560,000 in comparison to the other markets. Next slide. So this is a cash rate versus the inflation rate. I'm sure Paul will probably speak to more of this, but understanding that cash rate now at 3.6, in context of the last 20 to 30 years, money is still very cheap. And that's important to note. When you look back to where it was in the 90s, cash rate there of north of 12%. That's the cash rate, not the variable. But also it's important to highlight is when cash rate goes up, or when the inflation goes up, you'll see the direct correlation with cash rate, right? It's really the only lever they can pull to try to tackle inflation. But the same is true when inflation does come down, correlation of interest rates does follow. So it's foreseeable. If you can go back again, sorry, I wasn't quite finished. It's foreseeable. I don't know if you heard Bill Evans from Westpac's statement during the week that he's forecasting 7 rate reductions early next year, could potentially even start at the back end of this year, and forecasting a pause in the next rate rise in April. Wait to see how that washes out. But what we will see is a stagnation of interest rates, and then arguably potentially a cutting, whether that's this year or next, and where that will land does still remain unknown. Somewhere between probably 275 and 325, if I was going to have a punt at that. But if you go to the next slide, it's important to note that there's a lot of media and sentiment around at the moment, particularly tailored towards national markets. Obviously, the big papers, the big media outlets, the big news stories come from Sydney and Melbourne. Here in little old Perth, we get dragged into these news stories. So there's a lot of negative media, and media can drive prices growing and fall. And we've seen that in Sydney from 2017 to really through that COVID period. FOMO media pumping that market up drove the last 20, 30% of growth. But the same can happen at the moment when it starts to spiral and things that go down, it starts to feed on itself. And that's what we're seeing play out on the East Coast. But Perth does get dragged into this conversation. Next slide. The way we look at Perth, though, is the reason these markets are so fearful is because there's a serious problem with affordability in the Sydney market. So I'm not discounting what's been written and what's been publicised, what's been reported on, because it is a problematic market when we look at Sydney on a macro level. The affordability index here, which we've spoken about in previous presentations, is the average wage consumed by the average mortgage. So take us back to October, the affordability index in Sydney was at 75%. So I'll give you context. For an average punter, that's 75% of their average wage is consumed by the average mortgage. So that's assuming the variable rate. Understand there's 800,000 loans that are going from fixed to variable this year. So it's assuming the variable rate. So the people that are coming off that 1.9% fixed rate now on a variable rate, 75% of your wages going to your mortgage. That's not feasible. So what has to happen? Prices have to come off. And that's what we saw. We saw at 75%, it's not affordable. Historically, this market taps out at about 60%, 63, 64%, has peaked at 67% back in the sort of late 90s. So at 75%, the market has to come off, and it did come off 12%. But even today, as we stand here in this presentation, we're still at 66%, still a very unaffordable market when the average of this market's about 50%. So the market will still have to come off unless wage growth outperforms price fluctuations, which it won't, and or interest rates come off, which there is potential of that in the foresight over the next 12 months. So that could ease this. But in the short term, next 6 months, we will forecast probably still falls in this market, not as aggressive as what we've seen, but certainly falls in the market. Next slide, we'll go through to Melbourne. I'll get through this macro data so we can dive into Perth. 47%, we're probably not going to see significant price falls in Melbourne. Again, it's not the same level of unaffordability as we're seeing in the Sydney market. If we go now over to Brisbane, this is why we like the Brisbane market post this interest rate rising environment. Brisbane's still very affordable in comparison to where it has been historically, so at 44%. That has been helped by a price decline in the market. So we do think once there's confidence, and when I refer to confidence in the cost of money, so stagnation in interest rates, we'll see this Brisbane market probably rebound, as well as Adelaide. And then we've got a little old Perth here, reporting on this. We've had some growth in the market. 2 years ago on COVID, the affordability index is at 22%. We're now at 29%. So still very affordable. And this is a big reason why we haven't had price falls like the rest of the country during this rising interest rate environment. We've had 10 hikes of interest rates, which will put stress on any market. But the Perth market, the fundamentals are strong. The market's held really strong because we don't have an affordability problem here. WA wages are the highest in the country with the exception of Canberra, and our property prices are the lowest with the exception of Darwin. So affordability hasn't correlated with the Perth house price market ever. If we go to the next slide, what I mean by that is, flick through again, so that we're diving into Perth now. There is a different news story here, right? Because where the market's holding, and it has held really strong throughout this uncertainty. And there's reasons for that. The drivers here in Perth are different to that on the East Coast. Next slide, please, Ben. And what I mean by that, historically, when you look at Sydney and Melbourne in isolation, when the cost of money becomes cheaper, those markets go on a run. We see pretty aggressive price growth. The same is true, though, when the cost of money becomes more expensive, we see those markets stagnate or potentially decline, which is what we're seeing at the moment. If you look at the Perth median house price over the last 20 years or 30 years, correlated with the cash rate, we've never been in correlation. We've been out of cycle to that of the East Coast. So if you look at the 90s, where prices went up by 100% from 92 to 99, that was during a rising interest rate environment from 5% to 7.5% cash rate. So variable rate, throw another couple of percent, 2.5% on top of that. Same as during that 2000 mining boom period where prices went up by three times. So we went from 150 to 460 during that period. So the cash rate went from 5% to 7.5%. At the same time, we've seen a 250% growth in that market. But the same was true through the period of time that we probably distinctly remember, 2010 to 2020. The cost of money went from essentially 5% cash rate to 0%, but we've seen no growth in the Perth market because obviously we come off that sort of mining boom, population growth was negative. Other drivers carry more weight in WA. And those drivers, which we're going to talk about now, are around population growth, jobs growth, and the supply side. So during that 2000s period was correlated with negative population growth and an oversupply of properties. Next slide, please, Ben. So in summary, we can distinctly look at Perth in really three cycles of stagnation and two and a bit cycles of growth. And that the green correlated, those green periods there are the growth periods. Obviously, the grey periods are the periods of stagnation. So two very distinct growth periods. When you look at Perth historically, when it goes, it does go quite aggressively, and the growth is pretty significant in comparison to other markets. When it stagnates, it does stagnate for long periods of time as well. So we believe we're very much in the early phases of that next growth period. Next cycle, next presentation. So in summary, these are the reports that we'll share to the viewers post this presentation. We update these on a quarterly basis, but what we track across the 30 population centres of Australia, key market indicators, supply and demand, affordability, confidence, money supply, investment value and risk. Comparing these research reports from market to market, the strongest markets in Australia at the moment, Perth, Rockingham, Mandurah, Bunbury, and then Daylight, Toowoomba, and then Rockhampton. So they're two regional Queensland markets. So looking at those data sets, one of those markets an hour and a half east of Brisbane, another one about 5 to 6 hours north of Brisbane. But diving into Perth now, which is probably why you've viewed and taking a lunch break to listen to me. But demand side of the equation, as we've discussed previously, population growth has a huge impact on the market. Back in the 15 to 19, we're losing 15,000 people from East Coast to West. Last year, we had our first positive interstate migration for 8 years. So we had 10,000 people move to WA from the East Coast for employment. And we also had just over 10,000 people come from interstate. If you listen to McGowan during the week, they want to push that skilled migration from east to west and or overseas skilled migration to 30,000 this year. So it'll be another 10,000 on what we got last year. That's a benchmark. He also doesn't believe we have a housing crisis or a housing shortage crisis, which is interesting because we certainly do. So at the moment, that becomes a realisation, it might be too late. If we go to the next slide. So people that are moving here, they're moving here for work because we've got really low unemployment. Next slide, very low underemployment. So that's people who are employed who are looking for additional employment. So if you look back the last 20 years, a fully employed market worked off of basis points of unemployment of about 5%, because there was 2% of the population that just don't want work, and there's 3% that probably want work, but as employees, we probably don't want to be hiring that sort of staff. So at 3.5%, we're really well over capacity in terms of an employment rate. And then we look at the job vacancies in the next slide. We're looking at a market now for the first time here in March 2023, vacancies exceed 60,000 job vacancies across the WA market. So think of SEEK, available jobs in WA, a balanced market. Historically, it's been about 25,000 vacant jobs. We're currently sitting at over 60,000. So that's putting a lot of pressures on wage growth, which again is attracting a lot of that East Coast talent. We track high-paying jobs, so that's jobs north of jobs north of $150,000 a year. There's currently just over 5,000 of those, and that's significant because that's enough for a chippy or a tradie in Melbourne on 80 to 90, potentially $100,000 a year can come and work in the mines for 6 months of the year here in WA for 160, 170. So that encourages that migration. If we go to the next slide, thanks, Ben. So for the first time in history, we may see the number of job vacancies actually greater than the number of people unemployed, which we've never seen in the WA market. Been tracking this since 85, but we haven't seen this in any other market in Australia. So that's significant because this will directly correlate into what rising wages. And again, like I said, we're the highest paid in Australia outside of Canberra. So if wages continue to rise, it's only going to encourage more of that migration, which is going to put more pressure on the property market. If we now go to the supply side of the equation, which looking at this is days on market and stock on market. So we've got these people that are moving to WA. Like I said, the target this year is 30,000 people to move here to ease some of that labour burden that a lot of employers are trying to attract. But when they come in, there's no stock. So days on market in the orange there has come down to 15 days. And it can't really get much lower than that. Obviously, real estate agents like to get their exposure, so they will take things to market for a period of time. But the stock on market's more critical because a balanced market, as you can see here, sits at about 16,000 properties. We're now down to 7,500. So 7,500 properties available to purchase for someone moving to WA or locally. And then if you look at the next slide, the rental market, which has been really topical over the last 2 years, we've seen vacancy rates drop from 6.5% now down to as low as 0.4% and dropping. So we look back as early as 2019. That wasn't that long ago. We had 7,500 properties available to rent on the market. Today, as we stand here, there's 1,700, and it's falling. So to say we don't have a housing supply problem is an understatement. We certainly do. If you think of 30,000 people, whether we hit that benchmark this year, probably unlikely, but even if we fell short and hit our last year target of 22,000 doesn't go into 9. And then the argument is, well, we just need to build more properties. If we go to skip through this next slide, vacancy rate, next slide is building approvals. If we look at building approvals, we're building less properties than we ever have. So we need to be building about 25,000 properties a year to keep up with this demand. We're building about 2.5 a quarter at the moment. That's building approvals. So the lowest they've been. So net that out, somewhere between 10 to 12,000 new builds this year. And a lot of that stock that was coming onto the market during that COVID boom isn't playing out the way it was expected because people are still waiting 2-3 years after the fact with just a slab in the ground. So there's still labour restrictions. That's only getting worse. Material restrictions are easing, but there's still problems, supply chain issues. So, and again, once we realise, or government realise that we've got a housing shortage and try to promote, I know McGowan's pushing this higher density policy, which doesn't go to Parliament until February next year. So we're 2 to 3 years away from actually being able to realise any supply into the market. So, and that's if we push the go button on this today. So I think we're going to find ourselves into a housing shortage, quite a significant shortage. And I think what you'll see play out in the media is going to be a lot of homeless, a lot of people without homes, and you're going to see rents really rise. And there's going to be an uproar about what people are paying for rent versus the balance between landlords and rentals. Won't get into that argument. Everyone's got an opinion on it. So I guess one way of looking at landlords have had lower rents or under-rented properties for the last decade. So it is good to see, as the cost of money going up, that their rent is also going up. But pushing through, if we look at the lay of the land, again, these are the top 30 population centres. Perth, for us as a business, we do believe that it's still early in the cycle, and I still get clients here locally thinking that we may be buying at the upper end of the cycle, the top of the cycle, based on what's happened over the last few years. 2 years of growth at 20% certainly doesn't, or has never historically represented a growth period for Perth. So we do believe, based on the data that I'm sharing with you today, that whether the market kicks off now, 6 months, 12 months, the next 3 years, we're going to see some positive growth within the market. So looking through now at some investment principles. Thanks, Ben. These are the probabilities. I won't go into too much detail, only to mention we measure these off the affordability index ceilings. So what that means is that the original graphs that I showed you with where markets can get to historically are a really good indication of where those markets tap out from an affordability point of view. And based on a cash rate of 3.6, a likely variable of 5.5, that's the capacity of these markets before they reach their affordability ceilings. So looking at that, we're looking at markets such as Sydney coming off 10%, Melbourne still having 7% capacity, Brisbane still going to have 35% capacity, and so on. So it's really important. And Perth, to hit its previous affordability ceiling, would have to double in value. Not saying that's what's going to happen to market, but to reach our 2006 high, our prices would have to double at that 3.6 cash rate. If it was to come off, some experts are predicting cash rate to return to a 3%, well, then we'd have to see 106% growth in the market, which is significant. But now let's go through some examples of some investment principles. Again, the fundamentals of property investment. When they're buying a primary place for residence or an investment property, the fundamentals remain the same. And that's buying long-term growth suburbs. And what does that look like? If we go to the next slide, for us as a business locally now, it's 37 suburbs. When I presented in COVID, it was 22. So we have increased our scope of where we're buying. Understand that Perth's got just over 300 suburbs, so very selective. So having some good methodology around where you're buying is important. If you do the very bare minimum and just look at infrastructure spending, school catchments, zoning density changes, and average incomes, those bottom four pillars, that's a really good baseline to start when looking at what suburbs can or cannot potentially outperform the market. When looking at the asset quality, again, I can never stress this too much. If you go to the next slide, please, Ben. Looking at A-grade quality homes and try not to deviate from that. As a default rule, us as a business like to look at properties where 70% of the value is still in the land, because over time, that's what we'll appreciate. As a business, we're not interested in townhouses, units, villas, apartments, or anything that's compromised. And when I talk about compromised properties, refer to the next slide, please, Ben. We're looking at due diligence problems, and most commonly here is adjoining uses, and that's important. These items are very important when looking at buying a home, as well as an investment property. You want to go out and spend $700,000-800,000 on a home to realise 6 months in that the rear's been knocked down for apartment use, or next door has been knocked down for a childcare centre. Having 105 kids getting dropped off and picked up every day loses its appetite pretty quickly, as you can imagine, but also has an impact on the value, because the next buyer with a young family that doesn't want 100 cars on the street won't pay a premium for that property. Flooding, not as big an issue in WA, you would think, but the premiums have gone up because of what's happening in Victoria and the East Coast over the last 2 years. So, and there's far more flood zones in WA than you recognise. Same with bushfire. North Beach is a good example of that, but bushfire zoned areas, insurance premiums are higher. Social housing, again, just knowing where it is important. Zoning changes, can't stress that enough. There's a lot happening in that space at the moment with medium density zoning changes, which will have an impact on the majority of the suburbs in Perth. So no one, 10, even 5 years ago, some suburbs were immune to this. This is certainly opening up higher density, which will impact, established properties, which is what we try to buy. Next slide is elective due diligence. looking here is you can never be too diligent when buying a property. For a lot of people, it's the biggest financial decision they'll make. So it's important it's done so with diligence. Most commonly here is non-conforming structural uses. Again, we're buying older properties. You think of Duncraig, Pabbury, built in the 70s or 80s. You got an owner builder in the 90s that went through, put it on a games room while he was at it, thought he'd had an ensuite, and we'll push out the back wall and add another bedroom. Never thought to tell the council. Council come knocking when you buy the property, where the approvals, they don't exist. And because this was done in the 90s, there's absolutely no probability. I will never say never. Very unlikely probability that this is now compliant. Well, that 800,000, 700,000 that you've just paid for that property, allocating $250,000, $300,000 for the improvement value, has now been discounted by 150k because you're going to have to knock off the games room, ensuite, and bathroom because it didn't carry approvals. So you can never be too careful in that space. Electric audits, the other things. The last thing you want to do is buy a property, go to rent it out, and you have to get an RCD, an electrical compliance certificate. It's a bit of a mouthful, to realise that the wiring is all faulty or outdated, and you need to replace that. That's a 10 to 15k fix minimum. So working through, next slide, Ben. Portfolio examples. We'll get through these pretty quickly. The key point of this is having diversification in your portfolio is really, really important, be that locally or on a macro level. So this is just some of the examples that we've been able to build out for clients. Really good example here of having good exposure across Australia and being able to get into South Australia, Victoria and Queensland prior to COVID, and Mount Hawthorn and Warnbro. So looking Rockingham and Mandurah, those particular markets during COVID, and that's netted out a really good diverse portfolio that's done quite well over the last 6 years. But understanding these markets is critical. Next slide, please. Happy to whip through these if we don't need to go through these portfolio examples in too much detail. So next slide, Ben. So home buying, yep, stay there, that's fine. So again, what's happening on a suburb level? Obviously, I'm not going to go through every suburb in Perth in great detail. Some home buying activity that's been occurring in our office has been pointed towards the western suburbs. Don't look at the 1 year growth rates. They're very skewed because of sales volumes can be quite low. Peppermint Grove coming off 20% is literally skewed by two sales this year, and then obviously 3 sales that occurred last year that were very high sales. But the 5 year growth rate, top performing suburbs across Perth have been Floreat, City Beach and Cottesloe. Northern suburbs, top performing suburbs, North Beach, Trigg, followed by Duncraig. And we're seeing a lot of activity in Pabbury as well. So we're seeing a lot through that northern corridor perform well, and we think will continue to perform well. What's happened when those coastal suburbs of Watermans, Trigg, North Beach, like I said, is now filtering into those other markets slightly east. If we go to what's happening in the commercial markets in the next slide, just in summary, there's a real standstill in the commercial markets. We're seeing transaction volumes down significantly, and last quarter saw transaction volumes down 66%, which is significant. So we've just got buyers and sellers at two completely different levels, probably 150 basis points apart at the moment. So we've seen yields expand by 50 basis points. So think of this space, industrial sheds were trading at as low as 5.5 as early as this time last year. They're now probably at closer to 6, but we've got buyers that want to be buying at 6.5. So it's still just a gap in the market, which means transactions are low. Our 1 year returns are now much lower than they were the 3 to 5 year returns, which is no surprise, particularly in industrial and healthcare. On the flip side, retail returns are higher than they were on their 3 and 5 year. That's on the back of COVID. Retail certainly wasn't the flavour during COVID, so they've seen a bounce back. But you'll see a 6 month lag in transaction volumes to yields expanding. So where we're seeing the opportunities in the next slide is really for the primary placement businesses, those vacant properties where we can add some value, stitch up good tenancies. That's where we're spending our time and space in this commercial market is really adding value to underutilised commercial properties. So in summary, next slide is that's a wrap from me. What I'm happy to do is to share the research reports as always from the markets we've discussed. Locally on the ground, what our buyers agents are seeing, and anyone who's probably been out on a Saturday home open is strong activity. So yes, there's a lot of negative media around about there's going to be a fall in prices and interest rates can continue to go up. We're not seeing that play out in Perth. Like I said, we don't have an affordability problem. Anyone that's been through a home open in the Northern Corridor over the last 4 weeks will understand that. 30 groups through, 5 or 6 offers. Anyone's trying to get a rental property in those markets, 40 or 50 groups, 15, 16 offers. So we're going to see rents rise. I think over the next 12 months, we're going to see a lot more East Coast participants in the market. When we looked at what happened in Perth during that COVID period, there was a lot of local buyers competing with local buyers. So home buyers dominated that space. We're seeing and competing with a lot more East Coast buyers agents for the first time ever. I won't say ever, but really I've been in Perth since 2012 and there's been a handful of buyers agents, and that's local buyers agents. We're seeing East Coast come over now here in droves. So I think we're going to see a different wave of activity, owner-occupiers competing with local investors, competing with East Coast investors, because our yields are high, our rental returns are higher. So it's going to become a very attractive place for East Coast investors, because yields in, say, Sydney and Melbourne's 2.5%. You've got a cash rate, or so a variable rate at 5.5%. Doesn't make it palatable to buy properties in those markets. Come to Perth buying 4.5% yields, it becomes a lot more attractive. So that's enough from me. I don't think anyone in this wants to sit there eating their lunch looking at a photo of me. So I'm happy to pass it back to you, Paul.
Thanks, Lockie. Hello, everyone. My name's Paul Moran. I'm a Director of Finance, as Ben said at the start, with McKinley Plowman. That was great, Lockie, really informative and really insightful. So thanks for that information, mate. Performance Properties, one of our preferred referral partners with McKinley Plowman, and the clients that have used Lockie's services and Performance Property Group services have been really happy and wrapped with their service. So, thanks very much, mate. Just a quick mention, with any questions that you may have, please just type them in, and Ben Hart at the end of it will have about a 5-10 minute session of any questions that you may have and go through those if you like. Just as an introduction, again, MPM Finance is part of the McKinley Plowman Group. We have access to over 35 different lenders on the consumer side, but also we do a lot of business and commercial finance as well. And we pride ourselves on being your financial solution experts and more of a relationship manager for you with the banks. The agenda for today will be pretty quick. Just going to touch on the RBA cash rate, what's happened with that, where it is, where it's come from, and potentially where it's going. We have a bit of an insight from Westpac. Lockie mentioned Bill Evans, who's the Chief Economist for Westpac, gave a presentation about a week and a half, 2 weeks ago. And then within a few days, we received another update from Westpac, kind of changing what Bill had mentioned. So that's quite interesting. What else has affected borrowers over the last 12 months? So not just the cash rate. What you can do to reduce your costs and hopefully reduce your rate on your loans, and what we can do to help with that. Next one, please, Ben. So the RBA cash rate, as Lockie mentioned, 10 rate hikes since last year. Current cash rate is 3.6 as of March. The last time the RBA cash rate was at this level was back in about May, June 2012. If you go back just under 12 months, that cash rate was at 0.1. So 3.5% increase since April last year. The economists, all the banks have different perspectives on what's going to happen over the next 6 to 12 months. Most banks are still indicating probably one more rate rise before June this year, with a bit of a pause. But the information we've just got from Westpac are saying that that's going to actually be paused in April, as I mentioned on the slides, but actually a rate cut coming in as of July 2023. And as I mentioned in the slide there, a week before, Bill Evans didn't foresee any rate cuts until next year, again, as Lockie had mentioned previously. So it's a bit of a change of tack from Westpac in particularly. So good news, we'll hopefully have, as I said, a rate pause in April, so no increase. And as it mentions on the slide, possibly a rate cut come July this year. Next one, please, Ben. So that's a bit of a graph. That's the updated graph that Westpac have sent us at the end of last week. So that was the green line is where they were foreseeing rates to go. So continuing to rise towards the end of this year with a bit of a plateau and then reducing as of early mid next year. But yeah, the red line is indicating what they're currently predicting with rate rises, or the RBA cash rate, to actually level off now and then start to come down as of July, and to be around that 3% mark towards the end of this year. So possibly about 0.5% rate cut between July and December this year. Next one, please, Ben. What else has affected borrowers? Well, it's been a perfect storm, unfortunately. And this goes to what Lockie was saying about affordability, and with clients, their capacity to service debt. So we've had the rate increases, which we're all aware of, but also lenders have increased their buffers on loans. So whenever you go for finance, the bank's always add on a couple of percentage more to allow for rate increases. APRA came out about a month ago to suggest to the banks that they increase that to 3%, where previously they were around anywhere from 2 to 2.5%. So that's a standard across most banks now, that the actual buffer is 3%. The cost of living, which we're all experiencing, has also forced lenders to increase their living expense parameters. So just for an example, up there with married client with 2 children, if you go back to 2022, that might have been about 3,700 is what the bank guidelines suggested, and that depends on income as well. Now that minimum is about 4,200 per month. And then also for older clients, the Royal Commission a few years back made it very clear that the exit strategy of how the clients are going to exit their loans prior to retirement is also a very important point that, clients need to be aware of, but also brokers, banks need to cover off on when we're doing loans for clients. Next one, please, Ben. Yeah, so what can you do to reduce your own costs? Obviously, debt consolidation, combining your home loan, personal loan, credit card debts, and tax debt if it's applicable. You just need to understand that when you do that, you can reduce your monthly outgoings, but you can sometimes increase the overall interest payable, because things like personal loans and credit cards are over generally a much shorter term. When you get a car loan, it's generally over 5 to 7 years, but if you put it on your home loan, potentially it can be out to 20, 25, 30 years. So you're going to be paying a hell of a lot more interest on that asset. We come across a lot of clients that have credit cards, and they may not be aware when you go for credit, banks take the limit on those credit cards, whether you use them or not. So, the average that banks assess credit cards at is 3.8% of the limit. So, on 10,000, that's $380 per month. And that doubles, obviously, if it's 20 grand and as it goes on. So if you're not using your credit card, I would suggest you reduce that limit just to give you potential capacity to service a bit of a boost. And a big one that we're looking at now for clients and helping clients with, we provide a free budget to our clients, is getting a budget done. It can really give you a good idea of where your money's going. And we're all a bit surprised sometimes. I think our entertainment expenses can be quite high, or higher than what we expect. And just gives you a bit of an idea, as I said, where your money's going and how you may be able to control that and bring that back in. What can we do to help? Next slide, please. Thanks, Benny. Negotiate with your current lender to reduce rates. We've currently had a really good story for a client recently, and this depends on your circumstances and your lending ratios and things like that. But we've recently saved a client about $11,000 negotiating with Bank West to reduce their rates, and that obviously is a huge help to their monthly outgo. we always try to go back to your original bank if we act on your behalf. That's usually the cheapest option. But if your current bank won't come to the market, and sometimes that's the case with a lot of the major banks, unfortunately, not all of them, but some of them we find that they don't want to go as low as some of the smaller banks, then a potential there is to refinance to another lender, reduce your rates, possibly extend the loan term again to reduce your repayments. But again, keep in mind extending your loan term increases the overall interest you're going to pay on the debt given you're going over a longer term again. Some of the lowest rates we're looking at the moment, with the recent rate increase, the March RBA rate increase coming in, 5.13, and other small lenders around that 5.24 to 5.44. We're finding most of the big banks, unless we negotiate, are at the high end of 5, low 6s. At the moment, that's just their market rates that they're advertising at the moment. Fixed rates are starting to come back a little bit, but that 5.1 is probably not indicative of the market overall for a 1-year fix. These are the lowest we can find. And as you can see, the banks are factoring in a bit of a rate drop because that 3-year rate of 5.39 is lower than the 2-year rate. And these are all dependent, obviously, upon your lending ratio, whether you're doing principal and interest or interest-only repayments, or whether the purpose of the loan is for owner-occupied or investment. As it mentions there, all of those rates we've mentioned are all owner-occupied, below 70% lending ratio and on principal interest repayments. So, another thing we can do for you that's not on there is obviously work in conjunction with Performance Property Group to hopefully help you buy that right home or right investment property, and try and get the best rates and offers going around for you at the moment as well. So at this stage, I might pass back to Ben Hart and then just see if there's any questions. Any questions come through there, Benny?
I have not seen any other than Eddie. Any ideas how to see the slides on a mobile device? Well, if you're still here, Eddie, no, I don't know. I'm afraid I figured you would be able to see them on any device, but the recording for the webinar will be going up on the MP website over the next day or so, and everyone will receive a link to where they can find that. So you can leaf through the slides there if that's what you want to do. If there's anyone else that wants to put forward a question that they've got, anything that they'd like to ask Paul or Lockie now, we'll give everyone a bit of time to pop that in. But otherwise, we will wrap it up there. So, yeah, anything to ask, go ahead.
And if you do have questions later on, by all means, you can email those through to us, and we'll certainly come back to you, either myself or Lockie.
That might be the way to go with it, actually. I'll make a note for myself when I upload the webinar link onto the MP website. I'll put Lockie and Paul's contact information below it. So if you have anything you want to email them specifically and sort of offline, then feel free to take it offline, and I'm sure they'd be happy to help. But other than that, if there's nothing more from you fellas, then we'll call it there.
Yeah, we'll wrap it up if that's all right. But yeah, just thank everyone for coming on board, and appreciate your time.
Thanks, guys. Thanks for joining. Thanks, Ben. Paul.
Right.
See you soon.
Awesome. Thanks all. See you soon.
Thanks, everyone. Have a great day. Bye.